Hi everyone, I'm Karan and welcome to Karan's Gyan. The news on focus for today is India's external debt data. As you guys know, at about 9 p.m. today, on the date of June 30th, RBI released India's external debt data. So, a lot of analysts look at this data very carefully because it gives them an idea about the trajectory India's external debt is taking, and it gives them an idea about the economy basically. As beginners or as amateurs, even you guys should have a look at this data because this data can tell you a lot of things in a very few points. So let's delve into this report and see what all we find out today. So RBI says India's external debt stood at $558 billion dollars in March. So, what is external debt? So, external debt is something that is taken from outside. If someone takes a loan from a foreign lender, that comes into external debt. So, basically, to sum it up for you, is external debt is the debt borrowed from foreign lenders. All right. So India has a debt which has been borrowed by foreign lenders, and this debt amounts to $558.5 billion dollars. Considering the size of India, this is not an astronomical figure, but let's look into the report. So, the report is saying India's external debt stood at 558.5 billion in March. This has increased by about $5.4 billion dollars. So I would say it has increased by about 3% compared to the year ago. So now here we are breaking down the debt for you. So it's saying commercial borrowing remained the largest component of the external debt with a share of about 40%. So commercial borrowing is basically borrowing by for commercial purposes. We can see it is at about 40% of this external debt. Non-resident deposits is at 23.4%. So what do I mean by non-resident deposit? Non-resident is basically NRI. So NRI who are making deposit in India, it is considered as an external debt because as I told you, external debt is debt borrowed from foreign lenders. So if NRIs are making deposit in India, NRIs are basically foreigners, and they are making deposit in India, and deposit can be looked at as a debt because if I make a deposit, I'll be getting an interest over it, similar to a debt where an interest is paid. So if I am giving a deposit to a bank and the bank is giving me interest, technically I can say it's more or less like a loan, it's more or less like a debt. The bank has a debt that it has to pay, which is the money I have deposited. So similarly, NRI deposits is considered as an external debt. So NRI deposits have been standing at about 23.4%, which shows how prosperous NRIs are abroad compared to Indians in India. Okay, moving on. Short-term trade credit is 18.2%. Short-term trade credit is basically, it's like a promise to pay because they are dealing with goods that are coming to and fro. So rather than settling in cash, every day, every week, every month, they basically give each other credits. And at the end of the quarter, at the end of the duration specified by them, they would settle the trade. So it's known as short term trade credit. It is for the short term. There can be a long term trade credit also, but it is not there in this report. So I don't guess long term trade credit is a lot. I would say long term trade credit is some more or less like a commercial borrowing only. Yeah. Hmm. So the third point, valuations due to appreciations of US dollar were at 16.6 billion. So as you know, rupee has taken a beating, and rupee has taken a beating against US dollar and major currencies. I remember a time when US dollar used to be 45, 50 rupees, but that was years ago, and today US dollars in like late 70s. something like that. So as you can see, there has been a difference of about, if I compare 6.6 billion to 15.4 billion. So because of appreciation of US dollar, about 1.2 billion additional hole is there. All right. Yeah. So another thing I want to tell you about external debt. So what happens in external debt is, whatever, if a foreign lender gives you a debt in dollars, so you can't pay him back in rupees. You have to pay him back in the currency that he gave you. So if he has given a debt in dollars, you have to pay him back in dollars. If he has given a debt in euro, you have to pay him back the debt in euro. This is because there can be, while you're paying back the debt, the price of rupee will change to dollar and vice versa. So basically, they're at a currency risk. So the lender, which is the foreign lender, he's at a currency risk, and he wants to avoid that currency risk. So he takes mitigating steps regarding it. So that's why he says, you have to pay me back the debt in the currency I gave you. Yeah, so going to the fourth point, so it's an extension. So in order to know what is the component of India's debt, it is 53.7% external debt is in dollar denominated. So dollar denominated debt is the largest component with a share of 53.7%. So more than half of India's external debt is in US dollars, which is understandable because US dollar is the currency that is used, that is an international currency. It is used for any and every purposes. It's considered a very safe bet. uh, the other component is Indian rupee, which is 32%, yen, which is 5.6%, and euro, which is 3.5%. Now you would ask me, why did I skip SDR? What is SDR? Is SDR is Singapore dollar? No, SDR is basically, if I take a loan, if a country takes a loan from IMF, it is given in SDR. So SDR is basically an international reserve asset. So it is not a particular currency, but it is a basket of various currencies. It has a lot of compositions of these currencies. It has basically, it is a basic basket of five currencies. So there are five currencies in this SDR. Yeah, like I said, it is given by IMF, and since IMF, the I stands for international, obviously they won't favor one currency. They'll choose a basket of five stable currencies and five dominant currencies, which in this case is obviously, number one would be US dollar, number two is euro, number three is Chinese yuan, number four is Japanese yen, and number five is pound sterling. So all the five prominent currencies. So, talking about borrower wise classification, so it says that the outstanding debt of the general government has decreased, while the non-government sector has increased. So, there are components to external debt. So, either a Indian company can take external debt, it can take money from a foreign lender, or it can be the government itself that takes debt from a foreign lender. So, it's saying that Indian government's debt has decreased, while non-government sector's debt has increased. Talking about the composition of companies that have debt. So non-finance non-finance corporations have the highest debt of 42%. So non-financial corporations are companies that are not banks, or that are neither banks nor provide finance services. All right. So it can be any industry. It can be, for example, just for an example, it can be Tata Steel, Tata Power, Dani Enterprises, or maybe you know some other company. But if I say bank, what is a bank? Bank is HDFC Bank, Axis Bank. If I say financial corporation is a company that provides financial services. It can be a housing finance company. It can be motor finance company. It can be some XYZ company that provides financing. So it's basically telling us the composition of the borrowers. So non-financial corporations have a 42% debt, uh, dep- whereas deposit taking corporations. So deposit taking corporations are basically banks. So banks have a deposit by non-resident, has non-resident deposits basically, like I told you, and non-resident deposits are treated as debt. So obviously deposit taking corporations would also be a part of this debt when we are talking about total external debt. So they stand at 28.3%. General government has 18.1% debt. So if you see, our government has only 18% external debt, whereas the rest of the companies in the country have about 4/5 of the external debt. So financial corporations, finance companies, it can also include banks. So banks can be included in deposit taking corporations also, and banks can be included in financial corporations also. Finance based companies that provide housing finance, loan financing, short term debts. Okay, so instrument wise classification. So how are these so what I mean by instrument is, how are these debt acquired? So there can be various ways to acquire debt. So it can be a type of you know it can be a loan, it can be a bond. Bond, it's like a debt security. It can be a bond, it can be a deposit basically, like I told you. There is a deposit by NRI people here, and it can be short term trade credit. So it can be credit. So credit can't be loan. Okay, so it can be credit, it can be a bond, it can be a loan. So it's basically telling us that loans are the largest component of external debt, which is about 35% or 34.8% to be exact. 24% deposits, trade credit and advances as 18.7%, and debt securities as 7.4%. Can be, like I told you, debt securities are it can be asset backed securities, or it can be bonds, it can be any debt security that is classified in the instrument as a debt instrument. So another important thing you have to see in this, which is something that needs to be considered. RBI is saying that debt service has increased marginally to 6.5% compared to 6.4% in the same period a year ago. So about interest rates have increased by about 0.1%. Right. So guys, this is it about India's external debt, and you can read more about it from the RBI data that has been released today. And I hope you like the video. Alright guys, have a nice day.